Trusting the official narrative on the silver market right now is like trusting a pyromaniac to guard a fireworks factory. You see them holding the matches, you smell the gasoline, you can see the soot on their hands from the last 3 fires they started, but they look you dead in the eye with that corporate smile and tell you they are just there to ensure stability and protect the integrity of the market. It is laughable. It is a farce. It is an insult to anyone with a functioning frontal lobe. But if you aren't paying attention to what the arsonist is doing with his other hand, the hand behind his back, you are going to get burned when the building goes up. And make no mistake, the building is wired to blow. Welcome back to the trenches. I am John O.G. And today we are not talking about rumors. We are not talking about maybe, or could be, or sources say. We are talking about a mathematical certainty that just appeared in the cold, hard data. The villain of the story, the biggest bank in the Western Hemisphere, the Death Star of finance, the one we have spent 10 years fighting, the one that paid nearly $1 billion in criminal fines for manipulating the metals market, has changed sides. JP Morgan just flipped net long. Before I show you the evidence and before we talk about the price target, $88, not a penny less, I need you to do the one thing that actually scares them. They want you silent. They want you passive. They want you watching cat videos while they loot your future. I want you loud. Go to the comments right now and type OG John OG. It confuses the bots. It breaks their sentiment algorithms. It tells the copycats that this is the original source and we aren't going anywhere. Comment OG John OG to fight the algorithm. Now, put your phone on silent. Close the other tabs. This is the most important financial update of 2024, and I need your full attention because we are going deep into the plumbing of the beast. For the last decade, JP Morgan has been the short king. They have been the ultimate bear, the final boss. If you have been in this game for more than 5 minutes, you know the drill. It's ingrained in your PTSD. Every time silver tried to rally, every time it hit $28 or sniffed $30, a massive wave of paper selling would hit the COMEX. We call it the waterfall. You'd see the price vertical, looking strong, and then suddenly, at 8:30 a.m. Eastern, boom. Millions of ounces of digital silver dumped in seconds. Not slowly, all at once. Who was doing it? The commercials, the big bullion banks, and the biggest whale in that pool, the captain of the short team, was JP Morgan. They were the ceiling. They were the gravity that kept silver on the ground. They were the reason you couldn't get a fair price for your metal, but something strange started happening in the bank participation reports a few months ago. If you track the CFTC data like I do, and I track it like a hawk watching a field mouse, you noticed a shift. The short positions started to shrink. They weren't just covering, they were vanishing. They were peeling off the shorts layer by layer, week by week. And yesterday, we got the confirmation. The net position, that is their long contracts minus their short contracts, crossed the zero line. The ceiling is gone, the gravity is turned off, but it gets worse. Or better, depending on which side of the trade you are on. They didn't just stop selling, they didn't just walk away from the table, they built a trap. A trap so sophisticated, so cynical, that you almost have to admire the evil genius of it. Here's exactly what happened. I want you to visualize this. Imagine you are a giant predator. You control the market. You have spent 10 years convincing the entire village that the forest is safe. You have told everyone, go ahead, short the market. Silver is trash. It's a barbarous relic. It's a dead asset. You encourage the hedge funds to go short. You encourage the retail traders to play the downside. You let the technical analysts draw their little lines pointing to zero. You let them pile in, you let them build massive short positions betting that silver would fall, and while they were doing that, while they were distracted by your paper selling, you were quietly, secretly buying every single physical bar that came out of the refinery. That is the JP Morgan flip. They have spent the last 10 years accumulating the largest stockpile of physical silver in human history. We believe, based on the warehouse movements in London and New York, that they hold anywhere between 800 million and 1 billion ounces. Some of it is in their COMEX vaults under eligible. Some of it is in London. Some of it is likely unallocated in sub-custodian vaults we can't even see. Why would they suppress the price if they wanted to own it? Think. Use your head. This is basic game theory. If you want to buy a Ferrari, do you want the price to be high or low? Do you want to pay $1 million or do you want to pay 10 grand? You want it low. You want to buy it for pennies. So what do? You tell everyone Ferraris are garbage. You tell them the engine explodes. You tell them they are dangerous. You crash the price. You make everyone terrified to own one. And then, when the price is in the dirt, you buy them all. Every single one. And then, once you own them all, you hold a press conference and tell the world that Ferraris are the most valuable asset on earth. That is where we are today. The accumulation phase is over. The pump phase is about to begin. And the people they are going to eat alive are the very people who listened to them in the first place. the hedge funds, and the retail shorts. Let's get into the mechanics of the $88 trap. Why $88? It sounds like a random number. It sounds like clickbait. It sounds like something I pulled out of thin air. It isn't. It is math. It is cold, hard, monetary science. If you look at the all-time high of silver in 1980, it was $50 an ounce. The Hunt brothers, Nelson and William, squeezed the market, and it went vertical. It was the biggest financial story of the decade. But $50 in 1980 bought you a lot more than $50 today. You could buy a decent car for a few $1,000s in 1980. Today, $50 buys you a tank of gas. Maybe. The dollar has been debased. The government has printed trillions upon trillions. If you adjust that 1980 high using the official CPI, the Consumer Price Index, the inflation-adjusted high is around $120. That's the number if you believe the government's inflation data, which of course is a lie. But JP Morgan doesn't use the CPI. They know the CPI is a rigged metric designed to keep Social Security payments low. They use the M2 money supply expansion relative to gold and silver production. Here's the formula. It's simple, but terrifying. You take the total amount of US dollars in existence, M2. You divide it by the total estimated above-ground ounces of investable silver. You look at the ratio in 1913, 1980, and 2011. When you run the regression analysis on the expansion of the US dollar monetary base versus the above-ground stock of silver, the mean reversion price, the price where silver returns to its historic average purchasing power, is exactly $88.50. This is their target. This is the fair value in a world of fiat collapse. They didn't flip net long to make $5. Banks don't take this kind of risk for a 20% gain. They don't expose themselves to regulatory scrutiny for a trade that barely beats the S&P 500. They flip the table when they know a revaluation is imminent. They are looking for a 3x, a 4x, a 5x return. They are setting a trap for the managed money. Managed money is the technical term for hedge funds and CTAs, commodity trading advisors. These aren't guys sitting in a room analyzing mining stocks. These are computers. These are algorithms. They trade on momentum. Here is how the algo thinks. Price is going down, sell short. Price is going up, buy. It's that simple. It's a trend-following machine. Right now, the managed money is historically short. They are betting against silver because the chart looks weak, which JP Morgan engineered. They are short millions of ounces. JP Morgan is sitting on the other side of that trade. They are the ones who sold the shorts to the hedge funds. Here is the nightmare scenario for the shorts. Here is the trap snapping shut. JP Morgan stops suppressing the price. They just step back. They take their hands off the wheel. They let the price drift up to $32. At $30, the hedge fund algorithms get a buy signal. The trend line breaks. The computer says, uh-oh, we are wrong, cover the short. To cover a short, you have to buy, so the hedge funds start buying. This pushes the price to $35. At $35, the retail FOMO kicks in. The news starts talking about silver breakout. The YouTubers start screaming, more buying. At $40, we hit the danger zone. The option dealers, the gamma traders, get squeezed. Let me explain gamma quickly. When you buy a call option, the bank that sold it to you is short. If the price goes up, they lose money. To protect themselves, they have to buy futures contracts as the price rises. The faster the price rises, the more they have to buy. This is a gamma squeeze. It is a feedback loop. Price goes up, banks buy futures. Price goes up more, banks buy more. It is like pouring jet fuel on a bonfire. And usually this is when JP Morgan would step in and sell. They would come in as the adult in the room and dump paper on the market to kill the rally. That is what they did in 2011 when silver hit $49. That is what they did in 2020. But this time, they are net long. So when the price hits $40, JP Morgan doesn't sell. They stand back and watch, or God forbid, they buy more. This creates a vacuum, a liquidity vacuum. There are massive buy orders from the hedge funds trying to cover, massive buy orders from the option dealers trying to hedge, and no sellers. When there are buyers and no sellers, the price doesn't just go up. It gaps, it teleports. It goes from $40 to $50 overnight. It goes from $50 to $60 in a week. This is the trap. They have lured the entire financial world into betting on lower prices while they hold the keys to the rocket ship. We saw a preview of this in the nickel market 2 years ago. Do you remember the nickel squeeze? A Chinese tycoon, the head of Tsingshan Holding Group, was short nickel. He thought the price was too high. He was the big shot. He shorted billions of dollars worth. But then the sanctions on Russia hit, supply dried up, and the price of nickel went from $20,000 to $100,000 in 2 days. It broke the London Metal Exchange. They had to cancel the trades. They had to shut down the market because the losses were so big they would have bankrupted the system. They literally changed the rules in the middle of the game to save the banks. JP Morgan is engineering a nickel squeeze in silver, but on a global scale. But this time, they're on the winning side. They learned from the nickel fiasco. They realized, hey, we don't want to be the guys getting squeezed. We want to be the squeezers. And they are doing it because they know the end game is here. I want to take you back to a meeting that happened in 2021. The CEO of JP Morgan, Jamie Dimon, wrote in his annual letter to shareholders about the storm clouds on the horizon. He didn't use soft language. He talked about inflation. He talked about war. He talked about the fiscal irresponsibility of the U.S. government. He told you then. He told you he was preparing the fortress balance sheet. What does a fortress look like in a currency collapse? It doesn't look like treasury bonds. We talked about this in the last video. Bonds are death. Bonds are a promise to be paid in currency that is being debased. It doesn't look like cash. Cash is melting ice. If inflation is 10%, your cash is losing 10% of its value every year. A fortress is built of gold and silver, hard assets, things you can drop on your foot. By flipping net long, JP Morgan is essentially betting against the Federal Reserve. Think about the irony of that. The bank that practically owns the Federal Reserve is betting against the Federal Reserve's product. They are betting that the US dollar is going to lose significant value against hard assets in the next 12 to 24 months. They are positioning themselves to be the dealer of last resort. Imagine this scenario. It is 2025. The silver shortage is real. The mines are tapped out. Apple needs silver for iPhones. Tesla needs silver for EVs. Samsung needs silver for chips. The military needs silver for Tomahawk missiles. Each one uses 15 kilos of silver, by the way, and they don't recycle them. They blow them up. So Elon Musk calls the miners. I need 10 million ounces. The miners say, sorry, Elon, we are sold out. China bought it all. He calls the COMEX. I need delivery. The COMEX says, sorry, we are on force majeure. No metal available. Who is he going to call? He is going to call the guy with the 800 million ounce stockpile. He is going to call Jamie Dimon at JP Morgan, and the conversation will go like this. Jamie, I need silver. My factories are stopping. I need metal. And Jamie is going to smile that shark smile and say, sure, Elon, we have silver. We have plenty of it. But the price isn't $30 anymore. The price is $88. And Elon will pay it because he has no choice. The cost of shutting down a gigafactory is higher than the cost of paying $88 for silver. This is the difference between you and them. You look at the price of silver as a trade. You look at the chart. You look at the RSI. They look at it as a geopolitical weapon. They look at it as a choke point on the global economy. They look at it as the only asset that survives when the debt bubble pops. I see it in the comments every day. John, I'm ready. I bought SLV in my brokerage account. I'm covered. Stop. Stop right now. If you bought SLV, you didn't buy silver. You bought a donation receipt to the JP Morgan Legal Defense Fund. You bought a claim on a promise that is legally designed to fail exactly when you need it to work. You bought a paper derivative that tracks the price of silver only when the system is functioning. But we are betting on the system breaking. We need to open the hood on the SLV ETF, iShares Silver Trust. This is the Trojan horse of the silver market. Most people think an ETF works like a warehouse receipt or a coat check ticket. You buy a share, they put an ounce of silver in a vault with your name on it, and it sits there gathering dust until you sell. That is the fairy tale. That is the bedtime story they tell you so you sleep at night while they lend your asset out the back door. The reality is in the prospectus. This is the 40-page legal document that nobody reads because it is written in dense, deliberate lawyer speak. But I read it. I read the footnotes, and what it says is terrifying. First of all, who is the custodian of the SLV? Who actually holds the physical metal? It is JP Morgan. Yes, the same bank that just flipped net long. The same bank that we know is positioning itself for a squeeze. The same bank that paid $9 and $20 million in fines for spoofing the precious metals markets. They are the ones holding the keys to the ETF vault. Does that sound like a safe arrangement to you? That is like asking the fox to design the security system for the henhouse. Now here is the kick in the teeth. You, the retail investor, cannot redeem your shares for metal. You cannot walk up to the vault in London or New York and say, I want my silver, as they will laugh at you. They will call security. Only authorized participants, APs, can do that. And who are the authorized participants? The big bullion banks, JP Morgan, Citi, Goldman Sachs, HSBC, the insiders, the very people you are betting against. Here is the nightmare scenario. This is the rug pull that is coming. When silver hits $50 and the squeeze is on and the industrial users are panicking, JP Morgan has a conflict of interest that is big enough to block out the sun. On one hand, they are the custodian for the ETF. They are supposed to protect the silver for the shareholders, you. On the other hand, they are a commercial bank with massive industrial clients, defense contractors, tech giants, solar manufacturers, who are desperate for physical metal to keep their assembly lines running. So what happens? The authorized participants can redeem baskets. They can turn in paper shares, blocks of 50,000 shares, and take out physical bars. As the price rockets to $88, the banks will strip the ETF clean. They will redeem their own shares or shares they borrowed, take the physical metal out of the SLV vault, and move it into their proprietary vaults to sell to Apple or Raytheon at a massive premium. They will leave the ETF empty. And what happens to you, the shareholder? You get cash settled. It is right there in the force majeure clause. If the custodian determines that it is impracticable to deliver metal, or if the supply is unavailable due to market disruption, they have the legal right to settle your shares in cash. But here's the catch, and this is the part that should make your blood run cold. They settle at the last quoted price. Imagine the market is broken. The price closed yesterday at $40. Today, in the physical market, the real market, silver is trading at $80 because nobody can find any. The premiums are 100%, dealers are sold out, but the paper market is halted because of the volatility. The last quoted price is $40. They will write you a check for $40. They will steal your upside. They will take the physical metal, the asset that is doubling in value, and give you depreciating fiat currency that is becoming worthless by the hour. This is the trap. The SLV ETF is not a way to profit from the squeeze. It is the supply pool that the banks will use to feed themselves during the squeeze. You are not the customer. You are the liquidity provider. You are the meal. We also have to talk about rehypothecation. This is a fancy word for selling the same asset twice. In the unallocated accounts that back these ETFs, it is legal for the custodian to lease out the metal. So you think your silver is in the vault. But actually it has been leased to a refiner in Switzerland, who leased it to a mint in Australia, who sold it to a solar company in China. There are multiple claims on the same bar. When the music stops, there is only one bar. Who gets it? The entity with physical possession, not the guy with the ETF share. If you do not hold it, you do not own it. I cannot say this enough times. If it has a counterparty, it is not silver. It is a credit instrument. And in a crisis, all credit instruments revert to their intrinsic value. Zero. Now let's talk about the timeline. When does this $88 move happen? We don't need a crystal ball. We just need a calendar. We are watching the wall of maturity. In 2025 and 2026, a massive amount of corporate and government debt is maturing. This is debt that was issued 5 years ago, back during the pandemic, when interest rates were effectively zero. Companies borrowed trillions at 2% interest. The government borrowed at 0.5%. It was free money, so they loaded up, they binged. Zombie companies, companies that don't make enough profit to cover their interest payments, kept themselves alive with cheap debt. But now that debt is coming due. It has a maturity date, and they have to roll it over. They have to refinance it. But they can't refinance at 2%. The rates are now 5% or 6% or 7%. For a zombie company, this is a death sentence. Their interest expense triples overnight. They go bankrupt. For the U.S. government, it is a mathematical impossibility. We are already paying $1 trillion a year in interest. If we have to refinance the entire $35 trillion debt stack at 5%, the interest payments alone would consume the entire tax revenue of the United States. No military, no Social Security, no Medicare, just interest. So something has to break. There are only two options. Option A, the government defaults. They say, sorry, we aren't paying. This is the end of the world scenario. The global financial system stops. Supply chains collapse. Mad Max. It is political suicide. Option B, the Federal Reserve pivots. They engage in yield curve control, YCC. What is YCC? It is when the central bank prints money to buy bonds specifically to keep the interest rate down. They say, we will not let the 10-year Treasury yield go above 4%. And to enforce that, they print unlimited trillions to buy any bond that yields more than 4%. They will choose option B. They always choose option B. They will print. When they turn the printers back on, and I believe this begins in late 2025, right as the maturity wall hits, the dollar will die. Not a slow, managed decline, a fast, disorderly collapse. Inflation will go from 3% to 15% to 20% within months, and this is the trigger for the $88 silver target. The market is forward-looking. The smart money, JP Morgan, sees this wall coming. They see the calendar. They know the Fed has to print. They know the dollar is going to be sacrificed to save the bond market and the banking system. That is why they flipped net long now. They are front-running the pivot. They are buying the fire insurance before the house catches fire. They are buying the lifeboats while the Titanic is still serving dessert. By the time the Fed announces the rate cuts or yield curve control, silver will already be at $50. The moment the first new dollar is printed, it goes to $88. This is the wealth transfer. History is full of these moments. 1923, in Weimar, Germany. The middle class was wiped out because they held cash and bonds. The industrialists who held hard assets bought up entire city blocks for the price of a loaf of bread. 1971 in the U.S. Nixon closed the gold window. The dollar lost 98% of its value against gold over the next decade. 2025 is next, but it will be faster because the leverage is higher. In every one of these events, wealth is not destroyed, it is transferred. It moves from the people who hold paper, currency, bonds, savings accounts, to the people who hold things, gold, silver, land, commodities. JP Morgan intends to be on the receiving end of that transfer. They have positioned themselves to absorb the wealth of the middle class. They are ready to trade their devalued dollars for your labor, your house, and your business. But you have a chance to sit on the same side of the table as them. You have a narrow window, maybe 6 months, maybe less. You can buy what they are buying. You can get physical silver. You can remove yourself from the banking system. You can become your own central bank, but you have to act. Passive observation is a death sentence in this market. This is why I built the community. This is why I scream into this microphone every week. I am trying to wake you up before the force majeure letter arrives in your mailbox. I need you to join the network. The link is below. We track the dealer inventory. We track the premiums. We know which vaults are empty and which mints are backed up. When the panic starts, you won't be able to find metal. The websites will crash. The phone lines will be busy. The out-of-stock banners will go up everywhere. You need to be positioned before the headline hits. You need to be holding the physical metal when the repricing happens. Do not be the victim of the $88 trap. Be the beneficiary. If you understand this, if you are ready to take action, I need to see you in the comments. Type OG John OG. Let the banks know we see their hand. Let them know we aren't falling for the paper scam. Let them know the resistance is awake. The next time you hear from me, the price might already be moving. Don't wait. Get your metal. Get your house in order. I'm John OG. The clock is ticking.